Well, let's kick this thing off, Jordan.
All right.
I think I can tell already that based on our personalities and just talking like this in the green room, so to speak, that it'll be very casual. And so let's just make this thing happen. So I appreciate you joining the podcast as usual, just a casual conversation. And Jordan, uh, your background is as a real estate agent. And do you also invest on the side, or are you focused primarily on transactions?
No, I was investing on the side. I'm currently focusing on transactions more so in my business today, but that's due to the market shift.
Okay, maybe we'll talk about that in a little bit. Before we get into the market shift and kind of how to make those adjustments and kind of make the most of the market that it's given us right now, let's give the audience maybe just a quick background on kind of who you are, what do you do, and where you're from.
Yeah, so I'm from Windsor, Ontario, Canada. For anybody listening south of the border here, I've been in this business for 16 years. Actually, will be licensed 16 years March 4th. So around the time this is released.
Hmm.
So got into business. My dad was in the business since '88. Did a lot of real estate for about 10 years before I personally started investing.
Hmm.
But I helped a lot of people, of course, as a realtor, invest and learn and grow their businesses. And then one day you sort of wake up going, maybe I should do the same thing. That
Yeah.
was from one of my leaders in my company. He basically said, every great deal is passed through your hands, not to take anything away from anybody else, but you guys have a great opportunity to see a lot of real estate, a lot of real
Right.
estate transactions. Why are you not participating in the same benefits? So then in 19, that's when I really got into investing, opened up the corp, started to do that. And then we had the market shift. And so there's your
Uh,
transaction. I've done, I think, personally, I think I've done 12 or 13 deals that actually went well. And then I had a bit of a rough patch with the seven I bought after that first
okay.
13. So, yeah.
Of those 12 that you started with, what kind of properties were those?
So almost all single family residential, that really is what the predominant piece is in the city. And again, transactionally, cost effectively, those are a lot of times the most affordable.
Hmm.
And then again, at the time with the way rates were and everything was, single family residential hold was fine. You didn't need multi units to kind of get to cash flow because interest rates, of course, were running between 2.5% and
Sure.
3%. So
Yeah.
all the things and the metrics of the system back then worked really well on buy, renovate, refinance, the Burr model, right? Buy,
Sure.
renovate, refinance, and rent. And then you're laughing as you just sort of sit on the properties. And then the market kind of moved itself again more and more towards, buy, renovate, add other unit, other income to make
Yeah.
property more functional, or go student rental, which of course we have here in the city as well with the university and the college. So
And so you're doing these investments in Windsor?
yeah, I predominantly buy in Windsor. I've looked across the border in Michigan a few different times. There's just all the laws and again the when you jump countries, there's just rules that change. And not
Yeah.
that it's impossible by any means. It just I didn't get that far down the road. I was looking into it
Sure.
about how to expand across the border. But again, I have a high level of knowledge local, so it seemed like the best place to invest.
Yeah, you have an information advantage where you are because you know the market so well.
Correct.
And I don't know, I'm not sure how many Americans actually know this, but it's really interesting to understand the geography of Windsor around the Detroit area. I would wager that most people don't know that Windsor is actually south of Detroit.
Correct. Yeah, we one of the fun things is we always get that, and for most people who live in Windsor, and even the mayor at one point who is not allowed to leave the United States came to Windsor because he just viewed it as South Detroit, right? Like we're basically a suburb of Detroit because I can be across the border in 10 minutes. Like for me, if I want to go downtown, hockey town, or go to football
Mhm.
games or do any of that, I'm there. Depending on the border, but it what if you get through it, but to be at the border is 10 minutes from my door. So that's the cool
Yeah.
part about the city. We get smaller city living. We get around the city in about 15 to 20 minutes, pretty much anywhere you want to go. But we also have the big city right across the border. So we can just cross a border to all of the amenities that you wouldn't get if
Mm.
you were in this size of city, call it, 2 hours away or 3 hours away from here. You wouldn't have near the amenities that you get when you have a, 2 million population city across the street. So
Right. And so I have heard from a lot of Canadian investors that have said that it's just really, really hard to find cash flow in Canada. Is Windsor a notable exception to that, or does that fall in line with some of the bigger cities as well?
so Windsor, for most of its history, has always been cash flow and not equity. So one of the
Yeah.
things about Windsor for most of its history, especially when I started in '08, our average sale price was 157,000, and for
Uh-huh.
for here, that was very low compared to Toronto. It was probably at 550 or 600 at that
Right.
time. And so again, the thing about Toronto though is if you bought, you could run negative cash flow, but growth equity would allow you to basically
Yeah.
make your money that way. Here it was always you were buying the property for 60 grand. 5 years later, it was worth 70 grand, right? But most of it was all made. You could rent that out for $800 a month, make $300, $400 a month cash flow.
Hmm.
And that was how most people made their money. And today it's Windsor's for a cash flow city, we still are relatively inexpensive in comparison to bigger markets.
Hmm.
So again, we're right around 550, but Toronto's right around a million one, right? It's not like three times like it used to be, or even four
Right.
times. It's only about half, but again, that's still massive in the adjustment when you're looking at interest rates climbing from 2.5 to basically
Yeah.
6.5%, 5.5%, depending on how you can get a lot of investors, we can't use primary lending forever. You have to go with the second
Yep.
B lenders that'll work with you. So the rates are a little bit higher, but nothing that forever when you're renting out property and getting your money at 2.5%, even at $400,000, it wasn't bad. But that same 400,000 at 2.5%, and then jump it to 6.5%. Well, that's a lot more interest you're paying on that same 400, right? And so that eats
Mm.
into the cash flow, which is where adding those auxiliary units and finding ways with the property to maximize the space and potential has become one of the more unique things about our city is we do have a lot of old property. So it's a lot of basements unfinished, a lot of spaces. So you have to accommodate and find the ones that work, the ones that don't, and know that. And then you can really look to increase your cash flow, not necessarily still, again, we're not as much of an equity market as we were for about 5 years because the
Right.
market just did it. We're back into more of a long-term cash flow hold. And
Hmm.
you can find it if you do the right things and have the right, perspectives about what you're trying to accomplish.
Yeah, what you're saying there strikes me as being more akin in the US to the Midwest dynamics, whereas when you're talking about Toronto or Montreal, it's more of what we associate with California numbers, right? Or
Right. Yeah.
right. So that's if you're making a corollary to what he's talking about, if you know the U.S. market, that's not exact, but it's roughly speaking, that's how I would characterize that.
Yeah.
So you've been a realtor now for a long time. You've been investing for a while. You have some units, and you sound like you had some pretty good progress. But at somewhere along the way, there's a story of 7 units here that we need to hear about.
Yeah, so what it was I had finished one of my I bought a duplex, added the third unit, was finishing that project, and then after that project was completed, I had done a few other deals while that one was underway.
Uh,
So some wholesale deals, helping people like investing with people getting into properties, more continuing on the cash flow equity build.
mhm.
And then holding a couple along the way. And like, so again, starting out, you sometimes have the ability to hold, sometimes you don't. The biggest thing I found is finding people who have borrowing power is actually a huge asset more than cash. Cash is easier
Right.
to find. Borrowing power is really an asset that I've learned in the business. So what we did though was we again went down the process early of February of 2022 into mid-April of 2022, and we picked
Right.
up 7 properties basically in about 7 weeks. With the intention to close them, and like we had two starting in March, 2 projects going in March, we'd have two starting late June, and then we'd have two in July, and then finally one in September was kind of the prognosis layout.
Yeah.
Of course, with the idea that the market was not like again, it kind of took off at the beginning of 2022, and there was no end in sight based on the metrics. And then, of course, the election happened in the U.S. The war started in Ukraine. The interest rates changed. Everything kind of adjusted overnight, and it was really quick. And that's where everything changed for me because I built models, right? As an investor, I recommend modeling everything, right? Put all the numbers in, run it as it is, and then look at like, okay, so if the interest rate changes, which I put interest rates between 3 and 4%. So because again, you want to make sure the math works, but I just didn't perceive that we'd be at 7, right? Like I
Who
couldn't
did?
see it,
Right.
and
Right. Who did?
who could. So when that happened, all my numbers went out, right? We had a 31% correction. I had a 23% fallout rate. So the fallout rate means I could have lost almost 20% of equity, right? Because the objective of those projects is to burr them, perfect burrs, right?
Yep.
And so with a perfect burr, we had a bit of, wiggle room for other costs and things, but the idea was again, full capital out, maintain property. And so when that broke, the issue was when you're leveraging up 7 properties, it's a few, $1 million worth of real estate you're going to hold and it overcorrects by another 9%. Well, that's a problem, right? Like,
Yeah.
because we're not dealing in 100% values. It's not like I was leveraging, when you talk about 4 million, I was only really playing in the 20% of that. Well, when the market corrects for 30, Well, that's where you create a 10% issue. And so with that, that really reset your brain. Like for me as an investor and in helping people for a number of years, so fairly, been through the process with people right beside them, buy, sell, do all the things, all the some of the trouble that they get into, some of like all those lessons. This was just one I hadn't seen because even when you have the market correction in '08, that was a different correction than this most recent one, right? That was mortgages going like everybody overvaluing mortgages and then them losing their properties. This correction is an interest rate change, which causes everyone to be unaffordable in
Yep.
housing, which is a slightly different, it's the same net result to some extent, but it's a different metric that moved. And so when it moved, I didn't understand it well enough what it would actually do. And that means not only in real estate, but as an economy, right? The overall economics of that change. And so again, by the time I could kind of catch my breath and see what was going on, it was a fairly crippling event. And so after that, you go through these first, 10, 12 that went well, and then you get these seven. So you're pretty certain of yourself. Like I had pretty good, hard to lose would be the word I would say. I'd built a fairly indestructible, right? I
Yep.
like the Superman mentality. Like I'm indestructible, the 18-year-old, that hubris we kind of have
Yeah.
when we're young. It
Yep.
sort of can reappear. It's pride, right? It's that thing. And you're sitting there going, well, this was fun. So again, I look at it as my PhD in investing. I look at it as an investment into my future because at that point, the losses are there because once you have that correction, there's ways I mitigated. Of course, there's all the kinds of things I did, but I did liquidate every single one of them at the time to recapture my borrowing power with the intention, of course, to reinvest. And the
Hmm.
market's just sort of shifted to where it's really long-term hold. Well, when you have debt, you need, equity cash to pay
Yep.
back debt, and cash flow just isn't going to really make up for the change. And that's sort of been where I'm at now. So I'm not saying don't invest. I'm saying just remember your best laid plans can be best laid in your mind. But again, a lot of people looked at these plans and they didn't think there was anything wrong with them. But if you're not prepared to take the risk, meaning what it might cost you if things do
Yep.
go as bad as they did, and
Hmm.
I honestly believed I'd built catastrophic failure to some extent in, but I was wrong. And so again,
Yep.
good to know I'm wrong, reminding myself I can be wrong. And one of my coaches tells me, like Ray Dalio, he just assumes he's going to be wrong now. He just, you have to make all the right decisions. Assume, it's not to be inactive. Don't get fearful. It's about just
Yep.
don't think you're so right that you can't be wrong. It's the idea where you're going to be wrong some of the time. So don't make any investment beyond your risk tolerance that can't be completely wrong. Because if it can't be completely wrong, then don't take on those risks. And certain investments, of course, are more protected than others. And there's all kinds of ways to mitigate risk and do things through partnerships and other things in business. But again, learning a lot about myself and my perspectives in that moment was very enlightening.
Hmm. I bet. I bet. So, as a part of this in investment strategy, you I think to summarize there, you learn some important lessons, and one of them is that you make these pro forma projections on what's going to happen, and recognizing that more times than not, that is not actually what's going to happen. That's just what you think and hope is going to happen, and creating like some sort of flexibility, or like I don't know what you'd call it, but um, the ability to weather the black swan event that you don't know is coming.
Correct. And
Yeah.
and to understand what that might mean for you. And again, the biggest issue was if I had done three, I probably would have been fine, to be
Right.
honest. It was scale with expansion in mind, and the
Yeah.
opportunity was very like it's one of the things I've been told is some of the best decisions you'll make is to choose to say no, but it's really hard when you see $100,000 at the end of the line in the current economy.
Yeah.
And so that's what it's hard to say. When I looked at each of those properties I bought and creating that position, I was creating somewhere between 60 and 80 to 100 grand of equity just by making the purchase in the moment because the market was moving at such speed
Right.
that and so again I was cheating, right? I started to cheat the game and I got caught, right? Because what it is you're not realizing you're going to make those choices. But if in a stable economy like I'm in now, I look at the information so differently because I know the market change is only 2% up and 2% down, and we're staying fairly level overall. So, but I didn't assume that before. And so the decisions I made were based on market change, like based on the market continuing or to maintain some level of stability,
Right.
not a correction. And again, this is why I'm saying really evaluate your modus operandi, the way you're currently perceiving information and the way you're making decisions. Because if it works in a stable economy, it works in a down economy, and it works in a moving up economy, it's a good thing. If it only works as the economy moves up, be
Right.
very cautious. If it moves during stability, I think that's the most common sense place.
Sure.
And again, if you can figure out one that works as the market goes down, that's even better because again, then you're really protected against any change, right? And unlike the stock market where you can play the game if the market goes down, real estate really, I don't think there's as many opportunities to put a put on a real estate transaction. So
Right. Right. Well, and then with real estate, and you're talking about income producing properties, and you're not like flipping houses. You're buying for income for long term cash flow. These fluctuations really only kind of matter if you can't afford your obligations.
right.
And it's when you're and that's why this one was so painful is our obligations went up precipitously. It's like the cost of money went up so high. And in this case, when you bought these properties, were you on some sort of a flexible interest rate, or was it fixed, or how what's your situation?
So when the properties were bought, they were all bought with other people's money. So all around 12% interest while they
Oh,
were
I see.
in process with the refi after. So
Got
when you
it.
go to refi after that, like so we close for cash, ability to move at speed, none of the hiccups, and then the banks up here at least don't really like to let you buy a property, renovate it, and then refinance it for the full value. Whereas if you use private funds, then when you go to the bank to
Sure.
refi, they'll give you the 80/20 rule.
Yep.
So that's why we went that route. But again, so we were in a situation where the primary funds were already held at a huge interest rate. We're not stable enough to maintain that interest rate.
Sure.
And then we went to go refi. Well, the issue two parts to this thing. So not only was the cash flow out of whack, even if I tried to rent it, so was the equity. Trying to pull
Yeah.
equity, right? So to do the burr, this is like if I sold them, the benefit was I lost, let's call it 60 to $80,000. If I tried to burr it still, so let's say they would give me the money. Well, on let's say a $650,000 project, they'd only give me 480. Well,
Right.
480. Well, I'm leaving over like then how much money am I leaving in the project at 12% or however you want to look at those numbers? Like there was just like the crippling factor was I didn't understand how I understand interest rates as we speak about them. So if you speak about them in relationship to cash flow,
Yeah.
understood. In relationship to equity, understood. In relationship to all these things, I just never put them all together. I never spoke about them as one entity unto itself, meaning that in this scenario, interest rates change, XYZ happens. Equity pull goes down, cash flow goes down. So all these things change, costs go way up. Like I didn't put it all in the same metric. I just couldn't see it because I kept using the pieces of the puzzle as they looked, right? I took the piece,
Right.
I didn't put it into the puzzle. I looked at it and then I was like, okay, this piece fits here. But then I didn't look at the whole picture once it was together and how that same thing would effectuate all of it in one moment. And that's what
Yeah.
killed me. That's
Well,
if I can tell your audience one thing, it's really understand that metric because it's huge to not just real estate, but just in general, how interest rates affect life. So
yeah, it's so basically it's the cost of money, and even with it sounds like you even forecasted a potential rise in rates, and but they just went up way higher than anyone thought they would.
correct.
And so I'm curious in Canada when those of us in the U.S. we think about the American U.S. Fed, right? And
Mhm.
so when we change rates, I suspect that has a ripple effect to other economies, but I don't. That's not something I track. How much does that affect the Canadian economy?
I would assume we're literally attached at the hip, fundamentally on that we need our dollar to hold around a buck 35, a buck 28 somewhere.
Uh-huh.
So to buy it, you guys can get a dollar 28 to a dollar 35 in Canadian funds. So if you come
Sure.
over here, you save that. If it gets too high, either way, it's bad for either of our economies because as
Right.
much as we're about 10% of your population, 10% is still a big enough piece of
That
the
matters.
puzzle
Yeah.
in the US. But the
Yeah.
problem is you're 90%. And so if you move, we have to move our economy to follow. We kind of have to pair ourselves with the US economy. And because Canada and the US, unlike almost anywhere else in the world, it's funny, we're very similar. We talk the same.
We do.
If I go to the States and I go buy the food, hang out, everything's the same. We have very, very similar cultures till you
Yep.
get to actually how the countries are run. If you look
Mm,
at the engine inside of the countries, they're completely different wiring. It's so weird.
mm,
You have a president, we have a prime minister. You look at our banking industry, we have 5-year term on 25-year amortization, you have 30-year fixed, right? Like
right.
so many pieces of the puzzle. We use lawyers to close deals. You guys use your title companies. And,
Right.
and again, I know state to state it changes,
Yeah.
but it's so funny because in all reality, the car drives the same in Canada as it does in the US. The gasoline goes in this, like so many things are the same, and yet so many things are very different. And if you don't know that, it makes a big difference. And that's why we have people coming up to Canada using terminology they're learning in the States that doesn't mean the same thing when you cross the border. A
Mm,
cash offer in Canada is a true no conditional offer. A cash offer in the States generally just means a financing's already approved. Has
yeah.
been my understanding. And I tell people, I'm like, yeah, if you tell a Canadian realtor it's a cash offer, they're not going to put a condition at all. So you better
Right.
make sure
You
you've
better
got
have the
everything,
cash.
your ducks
Yeah.
in a row, because
Yeah.
it's just a different animal. And so all these little things. But yeah, the overall thing I will say about the US and Canada is yes, we follow you fairly closely. And when you guys, that was, if you look at the time frame, because I have gone back with one of my other business partners and we've looked at things, what happened. So you have the war, you guys raise your interest rate by 1%. We had already triggered 1/4 change, but my understanding was we were only going to do 1% for the year, which means we're going to have a quarter per quarter over the first part, which the first quarter hit. And I was in that, I understood. And that's why I built the
Yep.
model. Then you guys raised 1%. Then we basically raised, like, by the end of the year, we were at 7.2. You guys, I'm not exactly sure where you are today, but basically, like, everything changed. The rate went up by 5% instead of one, right? So that's,
Yep.
and you're going from a 2.5% interest rate to a 7% interest rate. Like, there's no, like I said, I accommodated for half. I accommodated for half of what happened. And when you guys moved, it really, I wish I would have understood at the moment you did that, what that meant, because then I could have made way different decisions.
I see.
Now that I know, if I see the interest rate in the Fed move again, that if we're ever back in the same market and I see this again, in
Yep.
that moment, I know exactly what it means and I know how quickly it's going to affect our market. It will be about a 30-day delay because
Lag.
basically
Yeah.
you guys move, then our government takes its next opportunity, whenever that is, because we have specific times it moves,
Sure.
and then that triggers. So again, economically, a lot of ways I've learned so much about how to, again, I don't want to pretend like I can read the crystal ball any better because that'll just get me in more trouble, but at least
Yep.
now I have better understanding when I see things to ask better questions, to make better decisions, to use that information in a more profitable way.